Secrets of Sand Hill Road by Scott Kupor. Picture this. You're 9 months into building your dream startup. Your co-founders? Mark Andreessen and Ben Horowitz, names that would eventually become legendary in Silicon Valley. Together, you've been grinding nonstop, and you just pulled off something remarkable. You raised $120 million for a company that isn't even a year old, at a valuation of over $800 million. $800 million. For an idea, a team, and a handful of early customers. It's the year 2000, right in the middle of the dot-com frenzy, and you're feeling unstoppable. You gather everyone for an all-hands meeting, practically glowing with pride, as you prepare to share this incredible news. You're expecting high fives, applause, maybe even some tears of joy. Instead, someone raises their hand. A young engineer asks the first question, and it completely blindsides you. He doesn't care about stock options or the company's roadmap. He just looks at you with genuine confusion and asks, "How come you didn't get a billion-dollar valuation?" That single moment perfectly captures the bizarre world of venture capital, the relentless pressure, the sky-high expectations, the almost mythical numbers that separate winners from losers. A competitor had just raised money at a billion-dollar valuation, and suddenly, your extraordinary achievement felt like falling short. The person who had to field that question was Scott Kupor. He was deep in the trenches at LoudCloud, the company that would weather the dot-com crash, completely reinvent itself, and eventually sell for over $1 billion. Years later, he found himself on the opposite side of the negotiating table as managing partner of Andreessen Horowitz, or a 16Z, one of the most influential venture capital firms on the planet, which he co-founded with those same partners, Mark and Ben. He's played this game from both angles. He's been the entrepreneur, pouring his heart into pitches, and he's been the investor, holding the fate of countless startups in his hands. In Secrets of Sand Hill Road, he reveals the inner workings of this mysterious world. This isn't just for aspiring founders who want to build the next tech giant. This is your guide to understanding the engine driving modern innovation. Venture capital fuels the technology shaping our daily lives, the apps we can't live without, the medical breakthroughs saving lives. Yet for most people, it's completely opaque. A closed club with its own vocabulary, unwritten rules, and hidden agendas. Today, we're cracking open that black box. By the end of our conversation, you'll understand the secret language of venture capital. You'll discover why a venture capitalist might reject a profitable company, why they seem obsessed with hunting mythical unicorns, and what they're really looking for when an entrepreneur walks through their door. You'll see the intricate dance of power, money, and control that unfolds behind closed doors. This is more than a summary. It's a masterclass in deal-making from someone who's truly mastered the craft. Whether you're dreaming of launching a world-changing company, becoming an investor, or simply curious about the forces shaping our future, you're in exactly the right place. Let's dive in. To really understand venture capital, we need to start with a surprisingly simple truth. Venture capitalists aren't risking their own money. This is the foundational secret, the one that explains everything else. It's the master key to this entire puzzle. When an entrepreneur walks onto Sand Hill Road, that famous Silicon Valley street where the top venture capital firms cluster, they're not just pitching to an individual. They're pitching someone who made promises to other people. Think of it this way. Centuries ago, Queen Isabella of Spain gave Christopher Columbus money, ships, and supplies. He had this audacious idea to sail west and find a new trade route to the East Indies. Most people thought he was absolutely insane, convinced he'd sail straight off the edge of the world. It was incredibly risky. But the potential payoff, a share in the riches from a new trade route, was astronomical. In that story, Queen Isabella was history's first venture capitalist. She wasn't risking her own life on the voyage. She was bankrolling the entrepreneur who was. Today's venture capitalists play a similar role. They manage money for massive institutional investors called limited partners, or LPs. These aren't just wealthy individuals. They're university endowments, like Yale and Stanford, funding scholarships and research. They're pension funds managing retirement savings for teachers and firefighters. They're foundations working to cure diseases and support the arts. These LPs hand over their money to venture capital firms for one reason: to generate alpha, returns so extraordinary they blow away typical stock market performance. A university endowment can't just park everything in an index fund and hope to keep pace with rising costs. They need to fund some risky voyages, hoping one discovers an entirely new world. This brings us to the second crucial secret of venture capital: the power law. Imagine you're a baseball scout looking for players who can consistently get hits. If you sign 10 players and 5 become decent hitters, getting hits roughly 3 out of 10 times, you'd be considered excellent. Your batting average would be .500, which is fantastic. But venture capital doesn't work that way. Venture capitalists aren't building a team of solid performers. They're hunting for one Babe Ruth. Here's how the math typically breaks down in a venture fund. Out of 10 investments, 5 or 6 will completely fail, returning absolutely nothing. 2 or 3 will return a bit of money, maybe breaking even. These are your singles and doubles. They barely move the needle. But 1, maybe 2 will be massive home runs, absolute grand slams. This single investment won't just make decent money. It'll return 10 times, 50 times, or even 100 times the initial investment. That one company, the outlier, has to pay for all the failures and still generate enough profit to deliver those incredible returns the LPs are expecting. This isn't a bell curve with most outcomes clustered in the middle. It's a power law curve, where a tiny number of winners account for nearly all the gains. Accel Partners, a renowned venture capital firm, invested early in a little company called Facebook. That single bet returned their entire fund many times over. What about the other companies in that fund? Honestly, it barely matters. The Facebook investment was the Babe Ruth that won the entire championship. This power law dynamic creates a very specific mindset in venture capitalists. It explains their seemingly bizarre behavior. They're not trying to avoid failure. Failure is guaranteed. They're trying to find the one outlier that transforms everything. This means they say no constantly. But the most devastating mistake for a venture capitalist isn't investing in something that fails. The career-ending catastrophe is a sin of omission, passing on the next Google. Missing that one home run is far worse than striking out 10 times in a row. So when you walk into that conference room as an entrepreneur, the venture capitalist is listening for one thing above all else. They're silently asking themselves, does this have home run potential? Can this company become so massive it returns my entire fund? If the answer isn't clearly maybe, the conversation is essentially over. This explains why venture capitalists often pass on perfectly viable businesses: a thriving regional restaurant chain, a successful consulting firm that could make their founders quite wealthy. These are excellent businesses, but they're not venture-scale opportunities. They're singles in a game where only home runs matter. This leads us to 3 fundamental questions every venture capitalist tries to answer when evaluating a new company. Scott Kupor breaks it down into people, product, and market. Let's start with what venture capitalists obsess over most: market. The mantra on Sand Hill Road isn't location, location, location. It's market size, market size, market size. A brilliant team in a terrible market will always lose. But a mediocre team in an amazing market can still succeed. The market is the wave, and the startup is the surfer. A world-class surfer can't do much with a tiny ripple, but an average surfer can ride a tidal wave incredibly far. How do you convince a venture capitalist you're surfing a tidal wave? Sometimes the market is obvious. If you're building new database technology to compete with Oracle, everyone knows that's enormous. The question then becomes about your product and team. But the most exciting opportunities often create markets that don't exist yet, or dramatically expand small ones. When Lyft and Uber launched, many investors looked at the existing taxi market and thought, it's decent, but not huge. They completely missed the point. The founders argued that with smartphone convenience, the market wasn't just taxis. It was every car trip. They weren't merely replacing taxis. They were creating a world where car ownership might become optional. That was a genuine tidal wave. Similarly, when Airbnb started, the concept was renting out air mattresses on your floor. An investor could easily have dismissed it. The market for people wanting to sleep on a stranger's floor is pretty tiny, but the founders saw something bigger. They were tapping into the entire global travel and hospitality market, even expanding it by making travel more affordable and accessible. Your job as an entrepreneur isn't just describing today's market. It's painting a picture of what the world looks like once your company succeeds, and why that world represents a massive opportunity. But even with a giant market, the venture capitalist needs to believe you're the one to capture it. This brings us to the second pillar, people. Since most early-stage startups have no revenue and barely a working product, the venture capitalist is fundamentally betting on the founder. They're looking for something called founder market fit. What about your life experience, your skills, or your unique obsession makes you the perfect person to solve this specific problem? Martin Casado, founder of a company called Nicira, exemplifies this perfectly. He spent his early career at the CIA working on the exact technology he was now commercializing, then earned his PhD at Stanford in that same field. His entire professional journey had been preparation for this one company. He had an almost unfair advantage. That's founder market fit. The founders of Okta, a software security company, both came from Salesforce. They had lived and breathed the problem their company was solving. They'd experienced it from the inside and knew precisely what customers needed. But it's not always about deep expertise. Sometimes being an outsider is the advantage. Herb Kelleher, co-founder of Southwest Airlines, was a lawyer. He once joked, "I knew nothing about airlines, which I think made me eminently qualified to start one." His ignorance of the rules of the airline industry allowed him to break them and create something entirely new. Beyond your background, venture capitalists look for a unique kind of leadership. Ben Horowitz and Mark Andreessen used to call it egomaniacal, though they later softened the language. It's a deep, almost unreasonable self-belief that allows founders to persevere when everyone insists their idea is crazy. Great ideas often look like terrible ideas, initially. A venture capitalist's job is finding good ideas disguised as bad ones, and it takes a special person to chase those. Finally, we get to the product. You might think this would be most important, but in the early stages, it's often the most flexible. Venture capitalists assume the product you're pitching isn't the one that'll ultimately succeed. What they're really evaluating is your idea maze. How did you arrive at this solution? What paths did you explore and reject? This reveals how you think. They're seeking founders with strong opinions, weakly held. This means you have conviction, but you're willing to listen to the market and adapt, or in Silicon Valley terms, pivot. Stuart Butterfield started a gaming company called Tiny Speck. The game was beautiful, but wasn't sustainable as a business. With only months of cash remaining, he approached his board. He explained that while building the game, his team had created an internal communication tool that made them incredibly efficient. He asked permission to use the remaining funds to transform that internal tool into a new product. The board agreed. That tool became Slack, now valued in the billions. That's the power of a pivot, and why venture capitalists bet on the founder's thinking more than their initial product plan. So you've navigated the maze. You've convinced a venture capitalist you're chasing a massive market, that you're the perfect person to do it, and that you have a thoughtful approach to building your product. They're excited. They say, "We'd like to offer you a term sheet." This is a moment of pure celebration, but it's also where the real game begins. The term sheet is the rulebook for your partnership, a document defining your relationship for potentially the next decade or longer. This is where the information gap is most dangerous. The venture capitalist has negotiated hundreds of these. For you, it might be your first. Scott Kupor dedicates a huge chunk of his book to demystifying this document, breaking it into two main categories: economics, how the money works, and governance, who has control. Let's start with economics. The first number everyone focuses on is valuation. A venture capitalist offers to invest $10 million, at a, quote, $50 million post-money valuation. What does that actually mean? Post-money means the company's value after the investment arrives. So if the post-money is $50 million and the investment is $10 million, the pre-money valuation, the value before the investment, was $40 million. The venture capitalist's $10 million investment buys them 20% of the company, since $10 million is 20% of $50 million. Now, you might think your goal is securing the highest valuation possible. More money for less equity seems straightforward. But here's one of the book's most crucial and counterintuitive lessons. An excessively high valuation can become a trap. Remember, you're not raising money just once. Most startups raise multiple rounds. Say you raise your Series A at a very high valuation. You've set an incredibly high bar. For your Series B, new investors will expect monumental progress to justify an even higher valuation. If you only double the business when they expected you to triple it, you might face a down round, raising money at a lower valuation than before. A down round is more than just a financial setback. It signals to the market and your employees that the company is losing momentum. It can create a death spiral of morale and confidence. It's often better raising money at a fair, achievable valuation that allows steady upward momentum, that classic up and to the right trajectory that keeps everyone motivated. But valuation is just the beginning. The real secrets hide deeper in the term sheet. The most important is the liquidation preference. This term protects the venture capitalist's investment. In its most common form, a 1x non-participating preference means that if the company is sold, venture capitalists get their money back first, before anyone else, before founders, before employees. Say a venture capitalist invests $10 million. If the company sells a year later for $40 million, the venture capitalist has a choice. They can either take their $10 million back, the 1x preference, leaving $30 million for everyone else. Or they can convert their preferred shares to common shares and take their 20% ownership of the $40 million, which would only be $8 million. Naturally, they'll take the $10 million. This seems fair, a way for investors to protect their downside. But it creates a fundamental conflict of interest, which became famously clear in a legal case involving a company called Trados. Trados raised nearly $58 million from venture capitalists over its lifetime. But the business struggled, and the board decided to sell. They received an offer for $60 million. With a $58 million liquidation preference, the venture capitalists would recover almost all their money. The common shareholders, founders and employees, would split just $2 million among themselves. But it gets worse. The board also created a, quote, management incentive plan, or MIP, rewarding key executives for closing the deal. This plan was worth about $8 million. So when the deal closed, the venture capitalists agreed to accept slightly less, around $52 million. The executives got their $8 million. And the common shareholders? They got zero. A shareholder sued, and the case went to court. The court's analysis revealed the harsh reality of the dual fiduciary problem. As board members, the venture capitalists had a legal duty to act in common shareholders' best interests. But as investors, their own financial incentive, driven by the liquidation preference, was recovering their money, even if common shareholders got nothing. The court found them conflicted. The Trados case is a cautionary tale every entrepreneur needs to understand. The terms in a term sheet aren't just legal jargon. They create real-world incentives that can dramatically change outcomes for you and your team. This brings us to governance, the second major category. This is all about control. Who makes the big decisions? The most important battleground is the board of directors. The board holds ultimate power. They can hire and, most importantly, fire the CEO. A typical early-stage board might have 3 seats, one for founders, the common seat, one for the lead venture capital investor, the preferred seat, and one for an independent neutral director. This creates a balanced board. However, in recent years, some founders have fought for founder-controlled or common-controlled boards, where common shareholders hold a majority of seats. This effectively means the founder can't be fired without their own consent. Travis Kalanick, Uber's founder, famously had this arrangement, which made it incredibly difficult for the board to remove him even amid widespread controversy. Conversely, a venture capital-controlled board gives investors power to replace the CEO if they believe the company is heading in the wrong direction. There's no single right answer. It's a negotiation, balancing trust and power. But understanding what's at stake, control over your own company, is absolutely critical. The term sheet also contains protective provisions. These list actions the company can't take without explicit approval from preferred shareholders, the venture capitalists. This might include selling the company, taking on debt, or even changing board size. It's another layer of control, a system of checks and balances on the CEO's authority. Navigating this complex web of economics and governance is like playing high-stakes chess. But Scott Kupor's message is that it doesn't have to be an adversarial battle. The goal is creating a structure that aligns everyone's interests. When venture capitalists and entrepreneurs align, magic happens. When their interests diverge, it can tear a company apart. The journey doesn't end with the term sheet. As the company grows, it faces new challenges. It might need to raise more money. And sometimes this becomes a difficult financing, a down round, or recapitalization. These are painful moments but often necessary to reset the company for future success. It requires honesty, transparency, and deep trust between founders and their investors. Then comes the endgame, the exit. For most venture-backed companies, this happens one of two ways: an acquisition or an initial public offering, or IPO. An acquisition is when a larger company buys your startup. Sometimes this is a wonderful outcome, bringing your product to a much larger audience. Other times, it's a disappointing end to the dream of building an independent company. More than 80% of venture-backed exits are acquisitions. The IPO is the holy grail for many. It's when the company goes public, selling shares on a stock exchange like the Nasdaq. For venture capitalists, this is their exit. It's when they can finally sell their shares and return that massive profit to their LPs, the university endowments and pension funds who trusted them years earlier. But surprisingly, the number of IPOs has been declining for years. Companies are staying private longer. Why? Because there's now a flood of private capital available from sources beyond traditional venture capitalists. Mutual funds, sovereign wealth funds, and hedge funds are all investing in late-stage private companies. A company like Uber could raise billions without ever going public. This profoundly affects the entire ecosystem. It means more value creation happens in private markets, captured by a small group of investors, rather than in public markets where everyday retail investors can participate. When Microsoft went public in 1986, it was valued around $350 million. Today, its market cap is in the trillions. Public market investors who bought at the IPO and held on have seen mind-boggling returns. In contrast, when Facebook went public, its valuation was already $100 billion. It's grown tremendously since, but a huge portion of its value creation happened while it was private. This shift underscores the changing landscape of venture capital. The world is flattening. Capital is no longer the scarce resource it once was. 20 years ago, the U.S. accounted for 90% of all global venture capital. Today, that number is closer to 50%. This is the final and perhaps most optimistic secret of Sand Hill Road. The game is changing. Access to capital alone no longer differentiates a venture capital firm. The best firms, as Scott Kupor and his partners at Andreessen Horowitz envisioned, now compete on value beyond the check. They act as networks, connecting their companies with talent, customers, and expertise. They're true partners in company building. The old world of venture capital was a kingdom where a few gatekeepers on a single street held all the keys. The new world is a global, democratized ecosystem where the best ideas and the best partners win. The secrets are out. So what do we take away from all this? As I've spent time with Scott Kupor's work, a few core ideas have really stuck with me, lessons that reach far beyond venture capital. The first and most powerful is understanding incentives. Secrets of Sand Hill Road is fundamentally about why people do what they do. Why does a venture capitalist behave a certain way? Because their LPs gave them a very specific mission. Why does a founder fight so hard for control? Because it's their dream on the line. Once you understand everyone's underlying incentives at the table, their actions stop being mysterious. They become predictable. This is a genuine superpower in life. Whether you're in a job interview, negotiating a contract, or working on a group project, take a moment to step back and ask, what does the other person really want? What are their constraints? What does success look like from their perspective? When you can answer these questions, you stop playing checkers and start playing chess. You begin seeing the whole board. The second lesson is the profound importance of market size. A great team in a bad market will always lose. This is such a simple but brutal truth. We so often fall in love with our idea, our product, our solution. We become convinced of its brilliance. But we fail to ask the most important question. Is there a tidal wave here? Is there a massive structural shift happening that our idea can ride? Don't just look for a problem to solve. Look for a wave to catch. The best surfers don't create waves. They just have the wisdom to see them coming and the skill to ride them. Finally, the book is a masterclass in storytelling. When an entrepreneur pitches a venture capitalist, they have no revenue, no profits, barely a product. All they have is a story. A story about what the future could look like. A story about why they're the one to build it. That story has to be so compelling. It convinces people to quit stable jobs, invest millions of dollars, and dedicate years of their lives to an idea that will probably fail. We're all storytellers. We tell a story to potential employers about who we are. We tell a story to universities about our ambitions. We tell a story to ourselves about the person we want to become. This book reminds us that the quality of that story, its clarity, conviction, and authenticity, can change everything. So how can you apply this today? First, start thinking in terms of founder-market fit for your own life. What's the unique intersection of your skills, passions, and experiences? What problem in the world are you uniquely suited to solve? It doesn't have to be a billion-dollar company. It could be a problem in your community, your school, or your own habits. Find your fit. Second, practice understanding incentives. Next time you're in a disagreement or negotiation, stop defending your position and start understanding the other person's. What's their power law? What's their home run? You'll be amazed how it transforms the conversation. This journey through Secrets of Sand Hill Road has been about pulling back the curtain on a world that seems impossibly complex. But at its core, it's about something very human, a partnership between people with bold visions and the people who believe in them enough to fund the voyage. It's a story of risk, failure, and the rare, spectacular successes that change the world. That was a summary of Secrets of Sand Hill Road by Scott Kupor. We've covered the highlights today, but I'll be honest, a summary can only ever be a map. The real treasure is found when you make the journey yourself. The true value of a book like this isn't just in the facts and figures. It's in how the stories and lessons connect with your own experiences, sparking new ideas and new ways of seeing the world. This summary is your starting point, a way to see if this is a journey you want to take. If anything we've discussed today has sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning. It's about equipping yourself with knowledge to navigate the modern world of innovation. You'll find a link to the book in the description below. Also, if you found this journey valuable, please take a moment to subscribe and give us a like. It truly helps us bring these ideas to more people. We're building a community of curious minds here, and I'd be honored if you'd join us for our next exploration into another life-changing book from the Billionaire's Bookshelf. Let's keep growing together.